Hi friends, how are you all? So, in this lecture we will be continuing with the basics of accountancy, and in this lecture we will be starting our main discussion into accounting concepts. Okay, as I have already told you, my method is to go through the definition. Okay, whatever I do, I will be first focusing on the definition of each and everything. In the accounting definition, we studied accounting as the art of recording, classifying and summarizing. We don't need to focus on the art. Recording, classifying and summarizing, these are the steps of accounting, right? Now, how should we record? What should we record? How should we classify? All these things we should know, right? But what happens is, first the transactions will be recorded and after that they will be classified. So in essence it comes that the conceptual framework is important only for recording, and for classification and summarization only the procedure is important. Okay, so how do we record? Okay, how, in what sense should we record transactions? Now, for basically concepts, first we'll write the concepts, and there are two systems of accounting. Okay, that is, see, let's take a normal shopkeeper. Okay, normal shopkeeper will not be able to record everything for systematic manner. Okay, here there are two things. Before we go into the systems, let us discuss the concepts. There are two things. We studied the concept of organization in the last class, right? What is the organization? What did we study of organization? Any enterprise, the accounts of which we are maintaining is an organization for us. Okay. Now, let us go to basics of business studies. We have studied the forms of business organization. Basically, if a person wants to do business, he can do it in three manners: sole proprietorship, partnership, or company. In the sole proprietorship, all the risks and rewards will be his. Okay, he will be the sole manager, he will be the sole owner, he might be the sole worker also of the business enterprise. Okay, in the partnership, it will be a combination of two or three people, but only thing, if the business fails, then they may have to repay the dues with their own assets, right? But the third business form is the joint stock company. Okay, there are many things like cooperative society and all, but mainly we are focusing on joint stock company. What is the peculiarity of joint stock company? There is one essential feature, that separate legal entity, right? Separate legal entity, what is it? That the enterprise is different from its owner, right? In the sole proprietorship and partnership, the enterprise is actually identical to its owners. But in joint stock company, the enterprise is actually different from its owner, and whatever money the owners bring into the enterprise will be taken as a loan, which the enterprise will have to repay later, right? But in accounting sense, we treat all enterprises as separate legal entities. Whether it be a sole proprietorship, whether it be a partnership, or whether it be a daily worker, the casual seller, anybody, any for enterprises for which we are using account, we will be treating them as separate legal entities. So what will happen if, when we treat them as separate legal entity? Any amount brought in by the owner will not be treated as the owner's money itself. It will be treated as money given by the owner to the business, so as for the business to survive. Okay, it is not the money brought by, just used by the owner in his business. It will be the money given by the owner to the business. Okay, this concept is called the business entity concept. That is, all business is treated as separate legal entity and it will be distinct from its owner. Okay, if Ram is a shopkeeper and Ram is telling us to maintain the accounts of his shop, we will treat as Ram as the owner, but the shop, we will be not be maintaining the accounts of Ram, we will be maintaining the accounts of the shop only, the organization only, and we will treat any money brought in by Ram as capital, okay, as his contribution, and the business, the shop is liable to give it back to Ram whenever he demands it. Okay, this is the business entity concept. Next, there are other concepts as well. See, there are, in transaction we'll have two impacts, right? If Ram is selling goods to Shyam, two things happen. If Shyam is paying money, Ram is getting that money. But simultaneously, Ram's amount of goods lying in his inventory has gone down. So two effects. One, the inventory going down, another one, the cash coming down. However, if Shyam is not paying money, Shyam will be treated as an asset, as a debtor. Okay, so similar situation happen. Two aspects are definite for any transaction. Okay, somehow or the other, two aspects will be definite. This concept that says that we should record both the aspects of any transaction is called the dual aspect concept. Related to dual aspect, we come to the systems of accounting. Okay, it is related to the dual aspect concept. There are two systems, single entry system and double entry system. In a single entry system, what happens is only one aspect of the transaction is recorded. The other aspect is not ignored, but it is not formally recorded. Let us say Ram is selling goods to Shyam. Ram is selling goods to Shyam. What will happen in this situation is, under single entry system, Ram will be recording the sale only. Ram might not record the transaction that the asset or Shyam has occurred. The Shyam has become an asset to us. He will only record that he has sold goods. But this is the single entry system. In double entry system, we record both the aspects of accounting. Okay, the shopkeeper in single entry system has any option. He can either record Shyam's as an asset and ignore the loss of inventory. However, generally this is followed by many people. Okay, but in double entry system, it is mandatory that we record both the aspects of any transaction. Okay, this is dual aspect. So we studied dual aspect and single entry system, double entry system. So this is recording. Okay. Then there is another concept related to recording, that is objectivity. What is objectivity? That account should be recorded in an objective manner. Okay, objective manner, that is, it should be free from bias of the accountant. If I am Shyam's accountant and I don't like Shyam, there's chance that I will be recording the value of goods higher, or I will be saying that Shyam should give more money than the actual. If Ram is selling goods for 10,000, might be I will be recording 20,000. So what will happen? The basic purpose of accounting is defeated. So the objectivity concept means that all transactions should be supported by some documents. Okay, whenever you buy something, you will see something called bill. It is also called invoice. Okay, invoice. Okay, this bill or invoice. So, only if the bill is available, such transaction can be recorded. There are also vouchers. Vouchers are another form given to bills. Basically vouchers, what they mean is, they are actually not purely bills. They can record anything. Any document that supports a transaction is called a voucher. Okay. So only if the voucher is available, such a transaction will be recorded. These are the three concepts related to recording of transaction. So we have completed recording, classifying and summarizing. Then we come to the next part, the significant manner. In significant manner, that means there are two concepts. Full disclosure concept. That is, all information should be recorded in accounting. We should not leave out anything. All information should be disclosed to the stakeholder or the users. Okay, but it should not be that everything in material or immaterial should be recorded. Only thing, everything that is required by the user in order to make an informed decision about our enterprise is required to be disclosed to them. More specifically than full disclosure, we have the materiality concept. The materiality concept states that only material things should be recorded. It is not that all things should be recorded. It is that only the material thing that can have an impact on the user's decision about our enterprise. Any person needs to evaluate our enterprise, right? It is not the management alone. Even outside investors will evaluate, the owners should evaluate, the customers should evaluate. So only the information that is required by the user in order to evaluate our enterprise should be disclosed. This plus this gives that all the required details and only all required details should be disclosed. Okay, these together say that it is not full disclosure doesn't mean you should evade materiality, and materiality doesn't mean you should evade full disclosure. Both together mean that all information without any errors that can have any impact on the user's decision about our enterprise should be recorded. So this is about significant manner. Then we come to the thing called next. What is the definition? Recording, classifying and summarizing in a significant manner. And in terms of money transactions and events, we have already seen what are economic events. Now we will see one concept related to money transactions and events, which is called money measurement. What is this concept? This states that only things that can be measured in the yardstick of money should be recorded. Okay, so that's what I told you an example. If Ram is engaging some person in order to ferry his goods to his customers, this transaction can be recorded in accounts only if Ram is paying that person a salary or commission or royalty or something like that. Okay, so anything that is recorded should have something in money terms. Okay, that is why we say which are in part at least of a financial character in the definition itself. That is, only thing that can be expressed in the type of money should be recorded. Now, if you have seen my videos in macroeconomics, in the lecture money, there is a point that is the function of money is unit of account. That is, it measures the value of all other goods. All other economic goods can be expressed in the form of money. Right. That is, here that means that only those things which can be expressed in the form of money should be recorded. So, another thing, when Ram sells 10 kg of goods, we should not record the 10 kg, but we should record the value of the sale and not the quantity. So, this is about the money measurement concept. There are many more concepts actually, but we will discuss those in the next lecture. It is actually a long part. So, in this lecture, we saw some concepts related to accounting and also the two systems of accounting. So, we will meet again in the next lecture, which is in that lecture we will discuss concept related to interpretation. And so till then, have a great time. Bye bye.